My name is Paul Sheard. I'm a research fellow at Harvard Kennedy School. Very pleased to be here for this great event. I'm a bit old school, so I'm going to use this whiteboard here from time to time. I prepared a handout for my talk, so that is already posted to the agenda, so you don't need to sort of take any notes. I'll pretty much what I say will be on that handout, so you can just sort of concentrate on my words rather than taking notes if you're so inclined in that direction. But I'll do a little bit of scribbling, which is difficult to resist the temptation for that. So my talk, I think it's going to dovetail very well, particularly with Eric's talk. Obviously, some thought was put into the sequencing here. So I want to talk about quantitative easing. Before I went to Harvard about 4 years ago, I spent about 25 years or so in the financial markets, starting off in Japan, and then based in the US. And as a markets economist, you do a lot of central bank watching, Bank of Japan watching, Fed watching, and what the central banks are doing becomes a real prime focus. And a lot of that has, in the last 20 plus years now, maybe 21 years, has revolved around quantitative easing. So it's a subject dear to my heart. So I'm going to do three things. First of all, talk a little bit about what is QE. Everybody sort of probably has a pretty good idea these days, but I'll talk a little bit about that. I'll talk a little bit about how it works, or maybe how it's supposed to work, because there are different kind of theories or different ways of describing the way in which QE works. And then I'll talk at the end about sort of what it reveals, particularly in the context of MMT and being here at the Levy Institute. And along the way, I'll sort of throw in a little bit of a history as well. But first of all, just to start with the definition, what is quantitative easing? I mean, it's quantitative and it's easing, so it sort of gives the game away. But I would define it as essentially when the central bank is purposefully expanding the size of its balance sheet in order to ease monetary policy. So it's basically making the balance sheet bigger and bigger. Now, that doesn't normally happen in normal times. Pre-QE times, that wasn't the way monetary policy works, and I'll come to that in a moment. So how do they do that? Central banks buy assets financed, so the assets are on the left-hand side of the balance sheet, financed by the creation of excess reserves on the right-hand side or liability side of the balance sheet. Most of the time, if you look around, an issue just came up, some of the questions that just came up very much bear on my talk here. If you look at what central banks have done with quantitative easing, most of the time they're buying government debt securities, treasuries, JGBs, bunds, gilts, whatever. Occasionally they do buy sort of risk assets, corporate bonds, equities, etc. We can talk a little bit about that, but I like to focus on what I call plain vanilla QE, which is where the central bank is purchasing government debt securities. So again, sort of gives the game away already. Everything is happening inside the context of the consolidated government. So just a little bit so that's the definition of what it is. A little bit on the history. The QE has sort of come in three stages. Maybe let me just pose a question. I'd like to get you folks involved. Who kind of invented quantitative easing? Which central bank?
Bank of Japan.
Yeah. Anybody disagree with that statement? Good. A very well-educated audience. That's good. So there were three rounds of quantitative easing in the modern era. First one was the Bank of Japan from 2001 to 2006. Lasted exactly 5 years. March, in fact, I can remember the day. I was sitting in front of my Bloomberg computer in Tokyo. I'd been to the Bank of Japan, met with senior officials a couple of weeks beforehand. Kind of everybody had a feeling something was coming. And I'll never quite forget that day when it sort of came across the ticker or the Bloomberg screen. And it wasn't described as quantitative easing. It took the Bank of Japan, in fact, I don't think they ever officially used the term quantitative easing. It was a change in their operating mode of monetary policy. But of course, market participants started to describe it as quantitative easing. And in their research papers and their conversations and everything else, the Bank of Japan adopted that term. And of course, later on with Governor Kuroda, he did start using the term quantitative and qualitative easing from April 2013. So the first round was the Bank of Japan. Now, there's a chart in the handout. I won't draw it right now. But if you go back and look at, say, the last 25 years of the Bank of Japan's balance sheet, you will see the recent QE, the last few years since the financial crisis. But you would need a magnifying glass to actually see the original Bank of Japan QE back from 2001 to 2006. In other words, by modern standards, by today's standards, they didn't do that QE on a very big scale at all. It was quite a very small scale, which is part of the reason it didn't really work very much. The second round, of course, was the global financial crisis from 2008, and the Fed was, I think, the first taxi cab to leave already in the fourth quarter, October, November, and then formally announcing in December 2008 that they were moving to cutting interest rates close to zero and moving to quantitative easing. Now, the Fed never uses the term, or again, officially, quantitative easing. They have a much worse acronym, which is LSAPs. They call it large-scale asset purchases. Given that the assets are all government-guaranteed securities, either MBS or treasuries, to call them assets is maybe a little bit too general, but it sort of obscures the fact that it's very much based on treasuries. Just on terminology, by the way, when we're talking about central banks, if you look at these charts of central banks having expanded their balance sheets dramatically, some of it is lender of last resort activity. You saw that in the global financial crisis. You saw it again with the COVID. Some of it is sort of marketed as credit easing, where the purchases of assets are sort of designed. So if you ask the question, why is the central bank expanding its balance sheet? In certain circumstances, it will be they'll phrase it in terms of trying to improve the transmission mechanism of monetary policy. So they'll sort of call that credit easing. Depending on the credit easing measure, I would sort of classify some of that just simply as a variant of quantitative easing, and some of it more as lender of last resort kind of activities or operations. But let's just focus on QE. In the second round, so we had the Fed moved in December 2008, the Bank of England in March 2009, pretty early on. The Bank of Japan, and this is quite ironic, given that it was the inventor or the innovator of quantitative easing, under Governor Shirakawa at the time was very slow to move and didn't really kind of do QE kind of stuff until about October 2010. And then Governor Shirakawa called it Asset Purchase Program, didn't call it QE. Again, there's a lot of language stuff that goes on here. Later on, under Governor Kuroda, it got ramped up substantially with this QQE. Then the third round, of course, is with COVID, and in the last 2 years, where there's been a really substantial ramping up of the balance sheet. So if you look at it, again, maybe I'll just draw a chart over time. If you looked at the Fed, so this is going to be 2008, and this is in the handout. The Fed's balance sheet went like that, and then it goes up and it comes down a bit, and then with COVID it's sort of like this. Now, of course, we're now about to head down, and we're kind of moving into this unwind of QE. Some people call it quantitative tightening. I won't go into that very much in my comments. Maybe in the Q&A you want to ask about that. But for quantitative tightening, it's just QE in reverse. So to understand the topic that is going to be on everybody's minds in the markets now, with the Fed, the ECB, maybe eventually the Bank of Japan, you really got to understand QE. Once you understand QE, it's pretty easy to understand the quantitative tightening aspect. So you've all seen charts like this. They're all a little bit different speeds, etc. But one thing to notice here is before the financial crisis, the Fed and other central bank balance sheets were increasing just in a kind of a steady fashion, maybe 5% per year. And market economists, by and large, or anybody, maybe MMT people might have been different, nobody really paid any attention to the balance sheet, the Fed's balance sheet. The Fed's balance sheet is published every week. Most of the central banks publish their balance sheets every week. For the last 10 years or so, market analysts have pored over the balance sheet, what's going on. In the old days, central bank watchers, if you'd said, how big's the Fed's balance sheet? Most of them wouldn't know. And if you go way, way back, prior to the early 1990s, in the good old days, when the Fed didn't even announce its policy decision. It would have a meeting, and then it would kind of, move reserves around a little bit, tighten or loosen monetary conditions, and then your Fed watchers would be looking at the data and what the Fed's doing, even on a daily basis. But once the Fed started announcing its interest rate decision, that was really what the markets focused on. So, I'm going to have to spray this. Oh, this is really old school, I think. Okay, doesn't like black. That's better. Okay, so I'll try blue this time. To get into this a little bit more, let me spend a little bit of time on the central bank's balance sheet and how things operated pre-financial crisis and pre-QE. So already, again, Eric's dovetails very nicely. I like to use a very simplified central bank balance sheet. So just write it as assets equals reserves plus banknotes plus government deposits. So that's, asset side, they're assets. Now, someone was asking before about, lending reserves. This asset could be the central bank buying assets, it could be doing repo operations, or it could be directly lending reserves to the banks. They're all just different ways of expanding the balance sheet. And again, different central banks do it different ways. Reserves are the deposits, the checking accounts that banks have at the Fed. Banknotes are the stuff that you used to have in your pocket, which increasingly, there's about $2.3 trillion of Federal Reserve notes. So it's not totally insignificant. And this is the thing that most people, even today, don't really think about very much, is the central bank is the banker to the government. In the Federal Reserve Act, section, I think it's 14, specifies that the Fed is the fiscal agent of the government. So again, underscoring the way in which fiscal and monetary stuff is really very intertwined. Again, in the old days, people didn't pay much attention or any attention to a central bank's balance sheet, but there's a lot going on in this simplified balance sheet. This is, of course, how cash gets into the system. So the role of the Fed or any central bank is to supply cash into the economy. Of course, however much is demanded by the public. An issue just came up about reserves and what's going on there. The reserves are the base money in the economy, the ultimate place where all the transactions that are going on in the economy are netted out. So if I wrote you a check, I bank for Citibank, you bank for Bank of America, I wrote you a check, you cash that check in your Bank of America account, then what would happen ultimately at the top would be money would go from the Citibank reserve account at the Fed to the Bank of America account at the Fed. And of course, only have a few banks and massive amount of transactions. So what's really going on, a lot of stuff just nets out. And then just at the end of the day, the sort of net positions are crossed over. So this R, reserves, is really a fundamental part of what people call the payment system or the settlement system. But it's also plays a critical role in monetary policy, as well as the assets as well. And then you have fiscal policy as well, which is very much operating through the treasury account at the central bank. So I like to put this in change terms and just rearrange. Running out of ink here. So do it in deltas. And put it this way, because what we're going to focus on with quantitative easing, this is where the action is happening with quantitative easing. This is going up. That's how the central bank does quantitative easing. It buys a whole lot of assets, and that goes up. So you can see here that there are really only three things that influence how reserves at, and I'll often slip into saying the Fed, but any central bank being influenced. If you say for a moment, well, for example, if this is not changing, and this is not changing, then you get that relationship. In other words, if banknotes go up, so you go to the ATM and you take some money out, reserves at the central bank go down. That just has to happen. You can assume that the other two things are not changing, because if you go to the ATM, that doesn't influence what's happening to government deposits or to the total assets of the Fed. Just the composition of the liabilities will change. Likewise, or maybe hard to see here, again, if the overall assets are not changing, nobody's going to the ATM to get banknotes or put them in, then if government deposits go down, reserves go up. Why would government deposits go down? Well, the government paying out money from its deposit account. Reserves go up. Vice versa, if government deposits are going up, because for one of two reasons, the Fed is taking in tax revenue, or the government is taking in tax revenue, that money goes into the government's account at the Fed, then reserves go down. They move in opposite directions. Also, as has been pointed out several times today, if the Treasury issues bonds, treasuries, bills or bonds, then reserves go down as well. So debt issuance by the central government or the Treasury is a reserves draining operation. So there are the three things that influence, two, and then the third one is change in R equals change in assets. I call this the fundamental equation of quantitative easing. Very, very simple. What it tells you is, again, if nothing's happening to banknotes, ceteris paribus, nothing's happening to government deposits, the central bank can increase reserves at will by acquiring assets. And there's no limit on that. This goes up, this goes up. Now, if we go back to, again, pre-financial crisis, what was going on? And I drew that chart before and said the central bank balance sheet is just going up gradually over time. If you looked at, so we have a thing called, don't hear about this much these days, minimum reserve requirements. Let me just say a little bit about how monetary policy operated in the old days. Again, because, my God, that's now pre-2008 for the Fed. Many of you may not have been paying any attention to this sort of stuff in those days. But it's important to understand sort of how things operated in the old days. Let me see if I can get some more space here. Again, all of this stuff is in a handout, so don't worry if it's sort of all scribbly and losing it. So, pre-financial crisis, and Randy mentioned this in his talk this morning, the Fed acquired the ability, the legal authority, to pay interest on reserves in October 2008. There was actually legislation passed in 2006 which authorized the Fed to begin to pay interest on reserves from October 2011. And then the financial crisis hit. And remember the famous TARP legislation, the legislation that authorized the Federal Reserve to be able to, the Treasury, to be able to inject $700 billion into the banking system. Tucked away in that massive bill was a provision that brought forward the ability of the Federal Reserve to start paying interest on reserves from 1st of October 2008. Now, this was just before, as we just heard from Eric, the Fed cut interest rates essentially to zero at the end of 2008, and of course interest rates were at zero until December, 0 to 25 basis points, until December 2015. So the Fed didn't really need that authority in those times. Well, they did to a certain extent. They were paying maybe 10, 15 basis points, but it was a bit moot. But of course, in the world we're in now, they do need that authority. So that was slipped in 2008. So how did the Fed operate before that? Well, reserves not paying interest, but there being a thing called required reserves. What are they? Required reserves, minimum reserve requirements, said on certain kinds of deposits, banks would have to hold on deposit, so that's on their liability side, they would have to hold at the central bank a certain fraction, 1%, 5%, 10%, depending on the kind of deposit. The idea sort of goes back to the great bank runs of the 1930s, that banks, there might be a run on liquidity at the bank, and banks should have, under fractional reserve banking, some liquidity held at the central bank. In some ways, the whole thing was a little bit moot because the central bank can provide that liquidity overnight anyway. So it's not like you really need to have this stuff sitting there, but that was the way the world operated. So pre-crisis, the total required reserves in the US were averaged about $43 billion. At the time, the Fed's balance sheet was about $900 billion. So most of the Fed's balance sheet was banknotes, Federal Reserve notes. 43, 44 billion were these required reserves. Now, what did that have to do with monetary policy? Well, if the Fed is not paying interest on reserves, which it wasn't, and what's it doing? It's targeting the federal funds rate. Now, what's the federal funds rate? That's the interest rate that banks are charging one another, or that's prevailing in the market for the interbank market for central bank reserves. On a given day, one bank might have a lot of reserves, more than they need to satisfy minimum reserve requirements. Minimum reserve requirements mean if I get to the end of the month, I'm Bank of America or something, and I haven't held, on average, enough reserves over that month, I get penalized. So I'm a bank, I don't want to pay a tax to the Fed, so I'm going to make sure I've got enough reserves. If I don't have enough, there might be another bank somewhere, Citibank or someone else, that's got more than they need. So that bank is going to lend reserves to me at an interest rate, right? So reserves don't get money if they're sitting at the Fed, but if one bank lends them to another bank, they get the interest on it. So what is that interest rate going to be? Well, the interest rate is going to be the federal funds target. That's the whole point. The Fed is trying to hit, let's say, 5%. What would happen if it woke up one morning and it left what are called excess reserves in the system? What are excess reserves? Excess reserves means an amount of reserves over and above the total minimum reserve requirements. Well, net, all banks are long excess reserves. They're trying to lend them to somebody, nobody wants to borrow them, the interest rate plummets to zero. Well, hold on a minute, it's supposed to be 5%. So the Fed cannot, in those days, could not, leave excess reserves in the system. What about the reverse? What happens, it comes in one day to work, the New York Fed, and says, oh my God, we've got insufficient reserves in the system. That means banks, on average, will be scrambling to borrow reserves, but you can't borrow what's not there, and what's going to happen? The interest rate's going to shoot up, 10%, 15%. You can't have that happen because, by definition, the Fed is trying to target 5%. So what will it do? Too many reserves, they'll drain reserves. Too few reserves, they'll supply reserves. In other words, again, they just exploit this relationship. But they do it in a kind of mechanical, defensive, passive way. It's not very interesting because we know at the end of the day they're always going to adjust their assets to hit the reserve target. So there's a chart in the pack, it's sort of very simple. If you look again over time at, the level of excess reserves. You can get this chart off the Fred database. Prior to the financial crisis, it's like that, and then it goes up, and pretty much it's the sort of mirror, or essentially it correlates very, very strongly with the chart we saw before. So in the old days, excess reserves were zero. No surprise at all. After the financial crisis, with QE, suddenly excess reserves go through the roof, to the point that in March 2020, see, I'm dating myself by talking about excess reserves, in March 2020, the Fed got around to saying, we're just going to abolish minimum reserve requirements. It doesn't make any sense. The Fed's balance sheet is now nearly $9 trillion. There's if you wanted to call them excess reserves, $6 trillion of excess reserves in the system. So they've just said minimum reserve requirements technically still exist, but they're now zero. So that's, again, quantitative easing. And that's kind of the really sort of both in the pre-QE era and the post-QE era, it all boils down to Fed is exploiting this very simple relationship between the two sides of its balance sheet, but it did it in very different ways. Okay, so that's quantitative easing. Let me say another thing just to link it to, and I'll come back to this point several times, link it to Eric's last point. So how do you think about plain vanilla quantitative easing? I like to describe it as a debt refinancing operation of the consolidated government, whereby the consolidated government, through the central bank, retires government debt securities and refinances them into central bank reserves or base money. Someone today mentioned Miller Modigliani. It might have been, I think it was Dimitri. Miller Modigliani, if you sort of think of corporate finance and Miller Modigliani, now you start thinking of the consolidated government as being like that. It's got liabilities which could be debt securities, it's got other liabilities which is high-powered money or reserves, also cash, but let's leave that aside, and it can switch between the two. And all QE is, at some level, is just the consolidated government doing that. Now, that immediately starts you thinking, well, I know that there's an irrelevance theorem for Miller Modigliani, under certain assumptions. You should already be thinking, well, QE couldn't be a very potent policy, right? Because if all it is shifting the debt profile around of one entity, that entity being the federal government. I mention again this because, every broker's report and every other kind of report on QE, you will see graph after graph like this, which shows this explosion of the central bank's balance sheets. Not just the Fed, but the Bank of Japan, the ECB, Bank of England, even the Reserve Bank of Australia, Bank of Canada got in on the act, other banks as well. And that kind of, early on in particular, a lot of people saw this. So people who had the money multiplier model or monetarist kind of model in their head and say, oh my God, this is going to be really inflationary. Because all this money is being pumped into the system, all this liquidity is being created, all this money printing is going on. And what Friedman told us, printing money will create inflation. It's coming. Where is it? Well, it's coming. What they don't tell you is, for every dollar that the central bank is pumping into the system, it's sucking a dollar of assets out of the system, usually government debt securities. So the net injection of stuff that I would call money is actually zero. Now a little bit, I don't know exactly about the MMT folks, how they use the terminology, but conventional economists, and you do your ISLM models and all your sort of monetary and fiscal policy stuff, conventional mainstream economists tend to make a sharp distinction between money, like base money, which starts with central bank reserves, and government bonds and debt securities. I mean, after all, one's coming out of the central bank, we call it money. The other's sort of the Treasury is doing that with debt management. And in the monetary aggregates, economists do not count government bonds or bills as money. It's an asset. It's not money. I think that's wrong. I think it's much better, and I think we've heard this several times today, to think of government bonds and reserves as being two different ways in which the money, the purchasing power that governments create when they run a budget deficit, are held, the form they take. So the real money printing with QE is not this stuff. It's the budget deficit that is usually going on, because as again Dimitri or somebody today pointed out, and Stephanie and others, most of the time, the natural position in an economy is for the government sector to be in deficit. So I think of the government's running deficits as being one of the two ways in which money, the feedstock of the economy, is flowing into the economy. The other one, of course, is bank credit creation, which we're not talking about today very much, but obviously is connected to central banking as well. So that's sort of, again, a way of thinking about QE. So what about how does QE work? Let me get onto that topic. Well, I've already said, first of all, I've sort of hinted that, well, it doesn't work very well. Now, I spent many years in the markets. I wouldn't call myself a QE fan, maybe a QE defender. And I was very much at pains, because there are two kind of schools out there. One was a kind of placebo school, kind of people who kind of did understand the consolidated government and the monetary mechanics here and said, hold on a minute, government debt, central bank reserves, once we're in a very low interest rate environment, they're basically substitutes, same thing. It's just like placebo. Not going to do any harm, much damage, but don't expect it to do anything. Then you had the money multiplier crowd at the other end who would say, oh my God, the tsunami of inflation is coming, it's just a matter of time. And I was sort of in between, more towards the first end very much towards the first end of saying, there is some effect of QE. It does have some monetary easing effect, but not very much. And I just made up for this presentation Sheard's QE theorem. If anybody wants to quote me on this, you can have it. But a point I've made for many, many years is that if you are in a world where you observe the central bank doing QE, you can take for granted that you are in a world where fiscal policy was not used aggressively enough to stop the central bank having to get to the point where it's used all its so-called interest rate ammunition. It's hit the zero bound or the effective lower bound, a little bit negative perhaps, and it still needs to do more monetary easing. How much more monetary easing? Oh, well, maybe $7 trillion worth if you're the Fed. Well, that tells me straight away, look, this is a discussion. Thank you, Fed. Pat on the back, you've done your best. But this discussion, when you get anywhere near the zero bound and anywhere near where central banks are doing quantitative easing or contemplating, you should be in a world where you're talking about fiscal policy. But of course, because we've been trained so much to worry about fiscal red ink and fiscal crises and balanced budget and everything else, fiscal policy, has taken a very much a back seat, again, until recently. So all of that's sort of starting to change. So again, it's not money printing. QE does not inject any net purchasing power into the economy. So it's not like helicopter money. It's not like you go out to your letterbox in the morning, people still have letterboxes, and you find, $10,000 check from the Fed or something like that. No, if the Fed buys $10,000 worth of treasuries, somebody is giving up $10,000 and getting $10,000 of a bank deposit, and then on the other side of the balance sheet, central bank reserves in exchange. So net, no additional purchasing power. Again, if quantitative easing, for all of these big numbers, is not injecting any net purchasing power into the economy, A, how does it work? I'll come to that. But B, you wouldn't expect it to be very potent. Right? It's got some effect, but it's not putting money in people's pockets, so it's going to be pretty mild, which is why we've had years and years of quantitative easing, and until the last year or so, central banks really struggled to get their inflation rates up, closer to 2%. So what does it do? Someone mentioned asset swaps before. There's two or three different ways of explaining it. One is that QE is an asset swap enforced on the private sector by the central bank. Buys assets, provides reserves in exchange. So how does that work? Well, I'll now say something that usually makes people's eyes glaze over. It works through the portfolio rebalance effect. Oh my God. What the hell's that? I mean, Bernanke loved this term. This is, Now, he's right, but it doesn't bring a lot of clarity to the world. But think about it this way. If the consolidated government is changing the profile, its debt profile, that means the asset profile of the private sector is being changed. How? Well, you've taken a lot of long-term government debt securities out of portfolios and you've put this very liquid base money in exchange. Now, if those two assets were literally, Modigliani style, perfect substitutes as assets, then it would be a placebo. But they're not. We have term premiere, we have duration, we have liquidity risk, etc. So there is some difference between those two assets. And so what I like to think of QE also in terms of, throw a little bit of finance theory in, which is in asset market equilibrium. In other words, by disturbing the composition of the private sector's portfolio, of course, portfolio rebalancing, what does that mean? Investors, people who've got these portfolios will say, oh, my portfolio is now a little bit out of kilter and I want to re-optimize it, and they start doing stuff. Now, typically what will they do? They've got, in aggregate, the private sector has to hold the increased amount of reserves that's been created. So in equilibrium, the marginal investor has to be indifferent between holding those reserves and holding everything else, kind of Tobin-style asset substitution, asset pricing theory. Nice to hear, I think it was Stephanie or somebody this morning, give a nod to James Tobin, although a very mainstream economist, and also, of course, the dissertation advisor to Janet Yellen. He really did a lot of some of the groundwork in reminding people that banks create loans, create deposits when they initiate loans, for example. So he wasn't in that loanable funds theory kind of camp. So nod to him. So asset prices, what happens? Equity prices go up a little bit, exchange rates weaken a little bit, bond prices go up a little bit, so the yield curve flattens a little bit. All of these changes, are pretty small in a big economy like the US, but at the margin, they may be stimulating or easing financial conditions a little bit. So that's kind of how it works. A trader's view, there is this stock versus flow argument. If I spent a number of years sort of around trading floors, and the sort of market trader kind of view of this is sort of, well, obviously if the Fed's going in and buying a whole lot of treasuries, that's going to, there's another bid in the market, and that's going to force prices down. Interest rates down, yields down. And if they stop, well, that pressure goes away and they'll probably drift up again. But it's kind of like it's another buyer in the market kind of thing. Okay, that's fair enough. But the normal economic theory is that it really works through a stock effect, which is that change in the composition of the private sector's portfolio. But you don't expect very much from it. Okay, I think we're running out of time, so let me put the foot on the accelerator a little bit here and move on to the third issue is, what does QE reveal? Well, what does it reveal to me, and what does it reveal to people in this room? Again, the funny thing about QE is, because the framework is one of separation of monetary and fiscal policy. And by the way, why do we have that separation? In some ways, because they understood the lesson of MMT decades ago and realized that if governments can create limitless amounts of money, they can stimulate limitless amounts of expenditure, and typically that will lead to inflation, and that's not a good thing. So we need to tie the hands, the government needs to tie its own hands. So I look at separation of monetary and fiscal policy, the independent central bank, as essentially being a credible, actually not just me, Paul Tucker makes this point very well in his book as well, but it's a credible, or it's an attempt to make the commitment by the government not to reflate the economy, to keep price stability. It tries to make that commitment credible. And it does that by separating monetary and fiscal policy. A lot of the MMT debate is around the MMT folks saying, well, actually, the underlying reality is different. I really don't quite understand why the mainstream and MMT can't agree on all of this, but there's probably professional reputations at stake and everything else, so pride and whatever. But that separation of independence of the central bank to me is really kind of, yes, of course, because we do know that governments can create money at will by not just buying assets, but more to the point, if you go back to the budget deficit point, run a budget deficit, you're creating high-powered money, and eventually that will cause inflation, so you better put some check and balance on that process. So what does QE reveal? Let me maybe explain this. So I think it basically explains or reveals a lot of the insights of MMT. And let me just, cast this as a sort of slightly personal vignette. I'm thrilled to be invited here to speak at this conference. I've never actually billed myself as an MMTer. I don't actually like all the different camps in economics. I like to, there's a lot of good economists, a lot of good insights. You try to find the best insights, Keynes, Friedman, Minsky, Aberlerner, et cetera, Randy Ray, Stephanie Kelton, even Larry Summers, my boss at Harvard's got a lot of, I think he's a brilliant economist as well. Don't see eye to eye to him on all of these other issues, but there's a lot of good ideas out there. Go and find the good ideas. But how I came to MMT was, as I said before, sitting in front of my Bloomberg, March 19th, 2001 in Tokyo, in Ark Hill's building, and this news comes across, and then we had to figure out, market economists needed to figure out what the heck is the Bank of Japan doing? And again, they didn't do very much, but it was different, and it was now saying, essentially the interest rate's going to go to zero, and we're going to start targeting reserves. So at that time, reserves were about 5 trillion. So reserves were about, let's call it 4.5 trillion yen, which would be like, 40 billion or something like that. And they started pushing them up to like 5 trillion. Eventually took it to about 35 trillion. But this is just a subset of the balance sheet. So the overall expansion of the balance sheet of the Bank of Japan, after 5 years of quantitative easing in those days, was only 40%, which is nothing by modern standards. But market economists like myself had to say, well, what's going on here? How is this supposed to work? And started digging into the sort of stuff that Eric was talking about and realizing that actually the central bank is the banker to the fiscal authorities, and all the fiscal operations are working through the central bank's balance sheet, and QE seems to have something to do with that. Again, I think of it this way. Governments run budget deficits, it creates reserves, but usually they issue bonds, kind of drains those reserves, and then QE just undoes it. And I've used a sort of term, maybe betraying my Catholic upbringing, a QE essentially moves us back into the monetary Garden of Eden, that more primitive state where there's no distinction between monetary and fiscal policy or monetary and fiscal operations. They're just different plumbing operations of this monetary economy that we live in. So I think what, to me, QE reveals is that the basic propositions of MMT are correct. If you go into QE and try to understand it, you start realizing, aha, these balance sheets are interconnected the way that Eric was talking about. And the narrative that then leads you to say, the narrative is actually different from the conventional narrative. Whenever conventional economists talk about QE, you almost will, the next sentence will be, I don't like QE because it blurs the distinction, it blurs the line between monetary and fiscal policy. To which my reaction is, well, so what? I don't lose sleep about that. Because that distinction between monetary and fiscal policy is a contrived, artificial distinction to begin with. And particularly in the kind of scenario that Japan has been in for many years. Now again, last year, inflation going through the roof. So the discussion about how do we get inflation up suddenly feels rather anachronistic. Remember, it was only August 2020, in the middle of COVID, that the Fed changed its monetary policy framework in the direction of saying we are now trying to overshoot on inflation, average inflation targeting. That was all motivated on the concern the Fed was having a lot of difficulty and was exposed, vulnerable to shocks that could push the economy into deflation. So the framework needed to recognize the asymmetric risks associated with inflation versus deflation. In other words, the risk was of deflation rather than inflation. They wanted a bit of inflation overshoot. Well, they sure got that. And you don't hear them talk very much about their framework anymore. It's kind of like, well, we're kind of over that. But that seems to me to be the key point. That again, when you're in a world of QE, you really should be in a world now of recognizing that monetary policy is not really very potent, and what you need is more if there's a blurring going on, I say bring it on. More monetary and fiscal joint action, joint coordination. If that results in too high inflation, then policymakers, both monetary and fiscal, can tack back in the other direction. And we sort of have a pretty good understanding of how that happens. There's one more reveal, and I call this the QE big reveal. And the QE big reveal is, when you think about QE as a debt refinancing operation of the consolidated government, where you're retiring debt securities, refinancing into central bank reserves, you say to yourself, well, okay, to what extent are these two things different? Well, to me, they're different in one regard, which I never hear people talk about. Again, I think because they don't want to draw attention to it. I'm talking about mainstream economists and central bankers and sort of the monetary and fiscal establishment, if you like, is that there's a big difference between a 10-year treasury and federal bank reserves. And one is, well, I'll pause for breath. What is it?
Interest rate.
Interest rate, well now of course you pay interest on reserves, so... Maturity, getting closer.
Duration.
Yeah. Say it?
Risk premium.
Yeah, no, it's a maturity issue, yeah.
Ability to use it to pay taxes?
Yeah, no, that's, sorry. Not, good point, but not what I was looking for. Okay, very simple. Reserves are like banknotes. I mean, after all, they're monetary base. They never have to be repaid. So, on the other hand, 10 years treasuries or, JGBs or whatever, ostensibly, and we heard it again from Eric, the fact that this is a little bit of a smoke and mirrors going on here, but ostensibly has to be repaid. Why do we worry about fiscal crises? Why do we worry about, we don't, but they worry about the looming potential fiscal crisis and fiscal sustainability? Potential insolvency of the government, because it looks like the government has to fund itself. It looks like it just can't create money. It looks like it has to go to the markets and say, please, pretty please, can you refinance my $28 trillion of treasuries as they come due, or more like 23 in the public's hands. Well, if it's all refinanced into central bank reserves, nobody comes knocking at the door saying, I want that money back. They're just like banknotes. You should carry a $20 bill around with me. I'm flush with liquidity. Take a $20 bill and go to the Fed and say, I want my money back. There you go. Oh, thank you. No, you hold on to it. They'll take it. Okay, give it to me. So this is a government liability, just like a treasury. Go to the bank. Of course, the Andrew Jackson is a little sort of inside joke, because he was the one who abolished the second bank, yeah. And so someone cheekily put him on the $20 bill note. They'll say, I want my $20 back. I'll give it to them, and you'll give it back to me. Well, I'm not sure who's going to end up with this $20 bill, but you get the point. Same with reserves. And again, key point from that balance sheet item before, is the Fed, or any central bank, having observed what you folks are doing, going to the ATM, and having observed the net flow of funds between the government and the private sector, it gets to decide the aggregate amount of reserves. Now, that might be too many or too little, but the Fed determines that. It's the hot potato syndrome. Those reserves have to sit in the system. They never have to be repaid. Now, they might be drained. The Fed might wake up one day and say, oh my God, we've got inflation at 8.6%. We need to start doing a QE unwind, and they can extinguish those reserves, just reversing QE, but that money never has to be repaid. Japan is probably the best example of this, and I've been arguing for years the following point. Japanese policymakers for the last 20 years, 25 years, have been worrying about two things, two big macro things. One is deflation, the other is fiscal sustainability. Now, the obvious, like MMT, Abelerna solution would be to say, well, if you're worried about deflation, spend a lot more money, you'll get rid of the deflation. The problem is the fiscal hawks in Japan say, oh, no, we can't do that. Our fiscal finances are terrible. Can't do that. So they're worried about those two things simultaneously. Whereas, if the Bank of Japan, which now owns 50% of JGBs outstanding, had said to the world, we are going to buy every JGB in existence, and we're going to buy any new JGBs as they come into existence, so we'll basically monetize the fiscal deficit. And we're going to start doing that, and we're not going to stop until we, because people would say, well, no, that will be inflationary. So, okay, well, we'll get some inflation, then we'll sort of slow down. Then one of two things would have happened. The Bank of Japan would have been successful in getting inflation up, or, as many Japanese believe, it's a hopeless cause, you would have ended up in a situation where not 1 yen of government debt, in quotes, that needs to be repaid is in the hands of the public. The only money in the hands of the public would be the central bank reserves and bank deposits created as part of that process as well. So I sort of fail to understand, why do you lose sleep about a fiscal crisis if there's no security that actually needs to be repaid? So let me end on that point. Some of this may segue into the panel we have later on, particularly the Japan stuff. But that's the long and the short of quantitative easing. Okay, the hand way back there. Yeah, I think you were the first up. Sorry. Yeah, go ahead.
Maybe I'm not understanding everything, but let me ask something. Yes, quantitative easing is exchanging one government liability for another, so bonds to hyper money. But they are not the same liquidity, because hyper money is much more liquidity itself. So it has some effects on asset prices, liquidity prices, and maybe investment, because you have more liquidity in your account. So my question is, first, there is some effects on prices in the market, in financial market, like for example cryptocurrency. Maybe we have much liquidity in hand, so we can take risks. And the other question, well, we are in the midst of seminar, so quantitative easing doesn't make our behavior more something, speculative. It's like we have much more liquidity now, so we can explore more risks, and maybe we are getting in the more stability, financial stability, like he says, like Ponzi and the speculative type of situation. That's the question.
Okay. Well, no. I agree. I think maybe I went too fast. I didn't explain it well enough. Yeah, I'm in the camp of saying yes, there is a difference between those two liabilities of the consolidated government. When you're close to the zero interest rate bound, not that much difference, but yes, there is some difference. You're taking term. So the way the Fed would explain it, and there's lots of central bank studies on this, to say, well, $100 billion of QE equals, 5 basis points on the yield curve or something like that. So yes, there is liquidity, term premium. My point is, see, a lot of people, and I put one on the reading list, that's banks, paper I'm somewhat proud of, repeat after me, banks cannot and do not lend out reserves. And even to this day, you will see very good economists in the media writing and saying, banks are parking their reserves at the central bank, or they're parking them for the moment, but just wait till they start trying to lend them out. And no, that's not how it works. But what I think does happen is, if you want to be theoretical about it from a finance perspective, is that the central bank has disturbed the equilibrium of asset market equilibrium, and those asset price equilibrium will be restored through a market process. And the net difference will be hopefully, and it should be, in the direction of some easing of financial conditions. And remember, monetary policy works indirectly. We have the policy committees of the central banks meet and they make these decisions about interest rates and balance sheets and things. All they're doing is try to influence financial conditions. Then you have to worry about, well, how do those financial conditions influence the real activity and inflation? So this can be a very tenuous kind of link. So yes, QE I think does work. I used to say it doesn't have no effect, it has a low effect. Back there.
You said that the thing about the quantitative easing is a debt refinancing. Now, I know the analogy doesn't hold, but I think where it breaks down with a firm, I think leads to understanding it's impotent. So tell me if I'm right. It's that normally a firm that refinances a commercial loan, the whole point is to increase your cash flow, right? You reduce your interest rate, your monthly payment goes down, you've increased cash flow. But that's a firm that is not a currency issuer. The reason this is impotent for the currency issuer is because refinancing that debt, the bonds, doesn't actually do anything to cash flow. It doesn't increase the money that the government has because the government is the issuer. Am I right in understanding it that way?
I think so. I mean, you can put it that way. Obviously the analogy, the kind of analogy between a firm, which the purpose of a firm is very different from the purpose of a central bank or consolidated government. So it's I'm stretching the analogy a little bit. It's really more to make the point that if you understand CFO kind of thinking and what CFOs are doing all day long, which is thinking about their capital structure. And now, why are they doing that? As you said, they want to lower their cost of capital, they want to increase their cash flow. But it gives you an insight into, it's sort of like that. But again, come back to the basic point. When we're talking about corporate finance and Miller Modigliani, we're talking about one company and it's very clear, two different items on the liability side. Again, the big problem we have in the public policy debate is that most people outside of MMT see the central bankers being over here and the fiscal authorities being over there, and they're doing very different things, and they've got almost different objectives, and one has to worry about solvency and another one has to worry about inflation. Whereas no, actually, how do you get an insight into it? When they're doing QE, now, some people have pointed out, QE is just a form of debt management. And the implication being, shouldn't the fiscal authorities be the ones doing debt management? Again, my response to that is, well, you can have these arguments about political issues, that, well, certain decisions should be in the realm of the polity, not technocrats, and I agree with that. But the central banks are ending up doing a whole lot of things that are political, but the fiscal authorities, think about fiscal policy for a moment. I'll leave on this point maybe, why aren't we thinking more, if we think that it's really important that the monetary authorities be these independent, politically insulated technocrats who are neutral and whatnot, why don't we do the same thing with the fiscal authorities? Well, the argument is usually, well, because there are distribution issues involved. Well, I think someone was mentioning, are you telling me there are no distribution issues involved in the transmission of monetary policy? There are. So we're not looking at monetary and fiscal policy matters on that integrated, coordinated, analytically sound basis. Again, QE, I think the central banks don't want to do this. They want to pretend this is just monetary policy and we're not financing the government or anything like that. But I do think it starts to lift the veil on the fact that these things are much more connected than we give credit for. And we've probably gone overboard in terms of this. You know, every card-carrying economist, macroeconomist has stamped on their forehead, have to protect the independence of the central bank. And that's why they don't kind of, you know, for a long time we're very uncomfortable with QE. I think we have to